For years, the message was the same from advisors, gurus, and every finance voice on YouTube. Do your Roth conversions early. Beat the RMDs. Taxes are going up. But the truth is, tax planning looks very different today compared to 5 years ago. And most advisors still haven't updated their advice. Strong market returns and several major tax law changes have completely reshaped how retirees should think about Roth conversions. And after years of building real-life conversion plans, one thing has become painfully obvious. Shrinking a pre-tax balance is much harder than people realize. Even big, aggressive conversions often barely make a dent under the market conditions we've seen recently. So make sure you stick around until the end, and I'll show you some real-world examples of this from the past few years. Combine that with tax law changes, and the old convert as much as you can early playbook just doesn't make as much sense as it used to. And if we haven't met yet, I'm Will, financial planner and IRS enrolled agent. I spend my days meeting with clients and my nights nerding out on tax and financial planning scenarios. So if you want help with this kind of planning, we can work with you too. Just grab some time using the link in the description. Today, I'm going to walk you through what actually changed, why large Roth conversions in early retirement are often less valuable than they've ever been, and what that means for your retirement plan. And of course, don't forget to smash that subscribe button for more strategies to lower taxes, invest smarter, and make work optional. Before we dive into the big changes, let's make sure we're all speaking the same language. A Roth conversion is simply moving money from a tax-deferred account like a traditional IRA into a Roth IRA. And when you do that, you create taxable income in that year. So at its core, a Roth conversion is just a decision to pay tax now instead of later. And when people talk about conversions, there's really three main things they're trying to achieve. First, paying tax today instead of paying tax later. And this is the piece that everyone focuses on, but it's really only one part of the puzzle. And whether it's beneficial or not depends on comparing your current marginal tax rate with your future rate, which might be yours or your heirs. And this comparison gets tricky quick between ACA premium credits, Social Security taxation, Medicare IRMA, whether a spouse passes first, heirs' income levels, and charitable giving plans where conversions often don't make sense at all. So this pay now versus pay later idea can be more complicated than people think. Second, using taxable account dollars to buy Roth space. If you pay the conversion tax using money from a taxable account, you're essentially giving up taxable dollars for Roth dollars and moving money from a tax inefficient bucket where dividends and capital gains create tax drag into a Roth with zero tax drag. And if you don't have enough cash in the bank or in a taxable account to cover the taxes, that's a good indication you can't afford the conversion, but there's always exceptions to this. And third, reducing future RMDs and the tax drag that they create. Roth IRAs have no RMDs for the original owner, and lower RMDs mean fewer forced taxable withdrawals, which only matters if you weren't planning to spend those RMDs anyway. The real advantage isn't just avoiding RMDs, it's preventing the tax drag on unspent RMDs that get reinvested into taxable accounts. And at the end of the day, reducing RMDs only helps if you'd reinvest those RMDs in a taxable account rather than spend them or donate them through QCDs. All right, now that we're on the same page about what conversions are and the reasons people generally do them, here's the part that most people miss. When you combine the last few years of strong market performance with the three huge tax law changes we're about to cover, you get a completely different retirement tax landscape. One where Roth conversions should be done strategically, not automatically assumed to be a net positive as in the past. So let's talk about what changed and why the old Roth conversion advice needs some updating. There have been three major changes that will dramatically reduce taxes in retirement. And together, they've reshaped the value of Roth conversions. First, RMDs now start at 75. Just a few years ago, retirees had to start RMDs at 72. And Secure 2.0 pushed that to 75 for anyone born in 1960 or later. That's 3 full years of RMDs wiped out. And because RMDs now hit later when fewer retirement years remain due to life expectancy, they simply matter less than they used to. Second, lower tax brackets and a higher standard deduction are now permanent. Many feared that tax brackets would jump in 2026 due to the TCJA sunsetting, but that didn't happen. In 2025, Congress made the lower brackets permanent and increased the standard deduction. This means future RMDs that would have been taxed at 25 or maybe 28% now often land in the 22 or 24% brackets instead. And more income is shielded by a larger standard deduction. When future tax rates drop, the tax rate arbitrage between Roth conversions drops with it. And number 3, a brand new senior deduction starts in 2025. Starting this year, retirees get an additional senior deduction, up to $6,000 per person age 65 plus, with high phase-outs, so many retirees will qualify. And when you combine the increased standard deduction, the original senior deduction, and the new senior deduction, a married couple turning 65 in 2025 gets $46,700 of deductions, which lowers taxes on withdrawals and RMDs, keeps more income out of the top brackets, and even potentially creates room for some tax-free Roth conversions. Put all this stuff together and the conclusion is clear. Taxes are going down for a large share of retirees. And when taxes go down, the value of accelerating income through Roth conversions goes down too. Now let's talk about something I didn't expect and no one else warns you about. It can be incredibly difficult to reduce your pre-tax balance in rising market environments, even when you do big Roth conversions. Why? Because compounding works against Roth conversions, pushing the balance up faster than most people can or want to convert. Now, this is a good problem to have, but something you need to be aware of nonetheless. Let me show you. Imagine you retired in 2019 with $1 million in pre-tax accounts, invested 100% in stocks. If you do 0 Roth conversions, with strong market returns, that $1 million grows to almost $2.6 million in just 6 years. Even with a 60-40 portfolio, which is even more realistic for many retirees, your $1 million portfolio still grows to $1.85 million over that same 6 years. Now let's say you convert $50,000 per year from the 60-40 portfolio. After 6 years, your pre-tax balance is still almost $1.5 million, meaning you converted $300,000 paying the tax on that money, and your balance still went up almost 50%. Even with 40% bonds, the pre-tax account is incredibly stubborn. The market simply outgrows the conversions. To actually shrink a pre-tax balance, your conversions need to exceed your portfolio's annual net investment growth. For example, with the $1 million portfolio, you need to convert and pay taxes on around $100,000 a year just to stay relatively flat. Convert any less than that and your pre-tax account grows faster than you can chip away at it. And for many in early retirement, this can be much more ordinary income than they need or want to realize due to reduced or eliminated tax credits. So even big conversions often can't beat market growth, which raises the real question. what can Roth conversions actually do for you? And here's the surprising part, and this is based on real modeling, not rules of thumb. Roth conversions usually don't make your retirement more financially secure. They don't meaningfully reduce your odds of running out of money. And that sounds strange at first, but here's why. Roth conversions solve problems that don't actually cause portfolio failure. They reduce things like RMDs, tax drag, and future taxable income. But those aren't really the risks that actually break retirement plans. And on top of that, with the changes we discussed, they just aren't as big of a concern. So, are Roth conversions even worth doing? To close this out, let me give you the framework for how Roth conversions actually fit into a real retirement tax plan. Because conversions don't exist in a vacuum, they work alongside your spending plan. Early retirement often creates naturally low income years before Social Security starts, before RMDs hit, and before taxable account sales generate income. Those low income years can create space within the standard deduction that you can fill up with conversions without pushing you into higher brackets. And that's really the point. Your spending strategy and your Roth conversion strategy are not separate plans. They're one integrated plan designed to smooth your tax rate over your lifetime and your heirs' lifetime. So, no, Roth conversions aren't the universal must-do people were told they were. But used strategically in the right years, at the right levels, and inside the right spending plan, they can still be a powerful tool. Thanks for watching, and see you next time.